Welcome, viewers, to Bodhi Unified Flow. Here, we simplify complexity and amplify performance. Today, we're diving right into topic number 7, parking emergency cash. Specifically, why you absolutely need to be using liquid funds and high-yield savings instead of volatile equity. So often people do the hard work of saving up, only to stumble right at the finish line by parking those critical funds in the completely wrong instruments. Well, in this explainer, we're going to completely dismantle that habit and build a rock-solid professional framework for your safety net. Let's get right into it. Here's a quick look at our agenda for today. First, we'll tackle the volatile equity trap. Then we'll look at high-yield savings and laddered FDs, followed by liquid mutual funds. After that, we'll map out a tiered allocation strategy and wrap up with a quick summary and our references. Our main learning objectives for today are pretty straightforward. By the end of this session, you'll really understand the core trade-offs between liquidity and yield. Plus, you'll know exactly how to dodge that volatile equity trap, and you'll have mastered a tiered allocation strategy so you're guaranteed to have instant cash the second a crisis hits. Okay, first things first, we've got to draw a hard line in the sand between emergency funds and equity investments. They literally have completely opposite jobs. Look, your equity investments, those are built for long-term growth. And yeah, you're gladly accepting high volatility as the price of admission for that growth. But your emergency fund, its only job, its literal reason for existing is capital preservation and instant access. Period. Mixing up these two goals, that's honestly where financial disasters begin. So that brings us to a really big question. Why exactly is volatile equity such a trap for emergency cash? Well, the allure of high returns in the stock market often tempts investors to just park their rainy day money in equity. I mean, when markets are roaring, leaving cash in a bank account earning 4 or 5% feels kind of like a mistake, right? You might catch yourself thinking, hey, why shouldn't my emergency fund work as hard as my retirement fund? But yielding to that temptation, trust me, it is a catastrophic error. Let's break down exactly why that is. Here are the actual mechanics of that trap. First off, sudden market sensitivity. Your portfolio could easily drop 10 to 30% exactly when broader economic downturns or mass layoffs are happening, basically the exact moment you need the money most. Second, exit loads. You're often hit with a 1% early redemption fee. And third, settlement lags. Equity redemptions take 2 to 3 business days to clear. Listen, in a medical or financial crisis, you just cannot afford a delay, and you absolutely cannot afford to sell your safety net at a massive 30% loss. And that leads us to one of the absolute most destructive forces in personal finance, the sequence of returns risk. Picture this. You've got an emergency fund, but it's parked in the stock market. A crisis hits, maybe a pandemic or a severe recession, and the market just tanks by 30%. On top of that, you lose your job, and you urgently need cash to pay rent and buy groceries. So what happens? You are now forced to liquidate your equity right in the middle of a bear market. By selling at the absolute bottom, you are taking a temporary paper loss and turning it into permanent capital destruction. You're effectively eating your own seed capital. This forced liquidation severely depletes your portfolio, and it permanently destroys your future compounding engine, because those units you just sold, they can never grow when the market eventually rebounds. So the main takeaway here is absolutely crucial. We have to keep this money safe. But realistically, how much money are we talking about? Well, financial professionals pretty much universally recommend a standard baseline of 6 months' worth of essential living expenses. That's your basic shield against income shocks. Now, notice the word essential there. We are talking strictly about rent, EMIs, groceries, insurance premiums, and utilities. The whole shebang of pure survival. We are definitely not talking about dining out, European holidays, or weekend entertainment. To put that into perspective, if your bare-bones survival expenses are 40,000 rupees a month, your baseline emergency fund needs to be at least 2.4 lakhs. And honestly, if you're a freelancer or you have highly variable income, you probably want to push that number closer to 10 or even 12 months. Right, so now that we've got our target amount and we know exactly what to avoid, where should this money actually go? Let's talk about our first highly recommended instrument, sweep-in fixed deposits, often called flexi FDs. These are essentially fixed deposits directly linked to your standard savings account. They give you a much higher interest rate, but here's the real magic. If you make a payment and your savings account runs a bit short, the bank will automatically break just a portion of the FD to cover it. That's it. Sweep-in FDs are your frontline defense. They give you instant 24/7 digital access via UPI or IMPS while generating a way better yield than a standard savings account ever could. Moving right along, let's look at the second major tool in our arsenal, Liquid mutual funds. These are open-ended debt mutual funds that invest exclusively in highly rated, very short-term instruments. Think government treasury bills and commercial paper. In fact, by law, the instruments they hold have a maximum residual maturity of just 91 days. You can think of liquid mutual funds as the nimble speedboats of your safety net. Because that maturity period is so incredibly short, they have virtually zero interest rate risk. They consistently outperform standard savings accounts, all while keeping strict regulatory safeguards in place to protect your capital. Okay, let's put our two safe havens head-to-head. On one side, we've got bank savings and sweep-in FDs. These give you absolute, guaranteed, instant 24/7 access. Yes, the yield is lower, but the credit risk is practically non-existent. On the flip side, liquid funds offer a really nice yield bump, which is fantastic for fighting off inflation. But, and this is a big but, you have to remember that liquid funds come with a T+1 settlement delay. That means it takes one full business day to actually get your cash in hand. Plus, they carry a very, very slight credit risk compared to a major bank. Truly understanding this trade-off, that is the absolute secret to mastering your emergency cash. But knowing the instruments is only half the battle, right? If bank accounts give you high liquidity but low yield, and liquid funds give you better yield but a slight delay, how do we choose? Well, here's the kicker. We don't choose just one. The real secret to financial resilience is all about how we layer these tools together. So, how exactly do we construct a financial fortress that gives us the absolute best of both worlds? Let's take a look. We do it by using a 3-tier allocation model. This architecture is like a giant puzzle that perfectly balances the liquidity yields trade-off. Tier 1 is your absolute frontline. We're talking 10 to 20% sitting in a high-yield savings or sweep-in FD. This is your 24/7 access money. This is the cash you can grab if you suddenly need to swipe your debit card at a hospital at 3 a.m. Then, Tier 2. You park 20 to 40% in laddered fixed deposits. This acts as a near-term reserve, giving you higher yields. And finally, Tier 3. This is the bulk of your fund, around 40 to 70%, held in liquid mutual funds, acting as your long-term buffer and inflation hedge. Let's zoom in on Tier 2 for a second, specifically that laddering strategy. Whenever you're parking cash in fixed deposits, never ever dump the whole amount into one massive chunk. Instead, you want to split that large sum into multiple smaller FDs. For example, instead of locking away one lock in a single FD, create 4 separate FDs of 25,000 rupees each. Why? Because let's say your car breaks down and you only need 20,000 for repairs. With the laddering strategy, you only have to break one small FD. You take the tiny pre-closure penalty on just that small portion, leaving the rest of your money completely untouched, so it can just keep compounding at that higher interest rate. It's such a simple, elegant optimization, isn't it? Now, as we're structuring all this cash, we need to set up a very strict behavioral boundary. We absolutely must separate the emergency fund from what's known as a sinking fund. An emergency fund is strictly for unpredictable, unplanned crises. A sudden layoff, a medical emergency, or your AC blowing up in the middle of a heat wave. A sinking fund, on the other hand, is for predictable, expected expenses. Things like annual school fees, festival shopping for Diwali, or your yearly car insurance premium. Listen to me on this. Do not raid your emergency fund for predictable annual expenses. You know Diwali happens every year, right? You should be saving for it entirely separately. So, you might be wondering, what happens if a genuine emergency strikes, but a huge chunk of your money is sitting in Tier 3, your liquid mutual funds, which have that T+1 settlement delay? How do you pay the bill instantly? Well, we use a brilliant little tactic called the settlement bridge. Here's how it works. Step 1. You swipe your credit card for the instant emergency payment. Step 2. You immediately place a redemption request for your liquid mutual funds. The cash will hit your bank account the very next business day. Step 3. You use those newly arrived funds to pay off your credit card bill entirely. This whole protocol lets you leverage your credit card's interest-free grace period, which can be up to 45 days, to completely neutralize that minor settlement gap of your high-yield liquid funds. It's a real game changer. Okay, so building the safety net is step 1. Maintaining it is step 2. You absolutely need a strict maintenance protocol. First, automate your savings. Set it up so 10 to 20% of your paycheck automatically sweeps into these funds before you even have a chance to look at it. Second, keep this money completely separate from your primary checking account. Out of sight means out of mind, and that protects it from creeping lifestyle spending. Third, make sure you review your target amount every 6 months to adjust for inflation and rising living costs. And finally, the golden rule. If you do have to dip into your emergency fund, you must immediately hit pause on all your other discretionary investments and aggressively replenish that safety net right back to its 6-month baseline. All right, let's quickly recap what we've covered today.
We highlighted the fatal flaw of the sequence of returns risk, which is absolutely critical. Then, we explored much safer alternatives like high-yield savings, laddered FDs, and liquid mutual funds. And finally, we mapped out a really dynamic 3-tier allocation safety net to help you actively and safely manage your cash reserves.
These principles we've discussed today are deeply grounded in frameworks championed by institutions like Vanguard, Charles Schwab, and Zerida Varsity. By engineering a structured safety net, you are actively protecting yourself from forced liquidation. And remember, true wealth isn't just about the massive returns you make when the markets are good. It's about the capital you protect when the unexpected inevitably happens. So I leave you with this. Have you structured your emergency tiers yet? Or is your safety net still full of holes? It's time to build that fortress. Thank you so much for joining us today on Bodhi Unified Flow.